Hi, everyone, and welcome to this new Silver webinar, where today we're going to discuss the topic of financial planning for real estate investors. I'll be your host, Ben Klanica. I'm the financial controller here at New Silver with a background in public accounting and real estate financing. For those that don't know, a little bit about New Silver is we're a trusted real estate lending partner who provides an edge with in-house design technology that helps provide a fast-paced, white glove-like service to borrowers in all types of real estate projects. Included but not limited to single and multifamily homes, commercial real estate, ground up construction, and fix and flips. We are pleased to have our main guest here today, Stoy Hall, the CEO and co founder of Black Mammoth, a well respected financial advising firm. Stoy has over a decade of experience in the financial planning, wealth management, and real estate investment spaces. So he brings us an excellent perspective here today to help bring value and advise current and future borrowers on how to best approach a real estate investment. Stoy, welcome. We're super happy to have you today. Feel free to begin by telling us a little bit more about yourself and what you do.
Yeah, Ben, I appreciate it. And like he had said, been in the industry. We're going on 15 years here in March,
Awesome.
which kind of makes me feel old but young at the same time.
Please.
No, I appreciate the opportunity to talk to everyone. Again, they talked about how New Silver is a white glove. We are too. Black Mammoth is a modern family office and designed around helping you in every situation in your life. And guess what? Real estate, as we all know, is one of the best investments there is. Plus, all the things that go into it. So today we want to do that. I want to challenge everyone on here today, as well as throw questions and comments throughout. We don't have to wait to the end of Q&A. We'll answer as we go through this thing. But I appreciate Ben having me on New Silver. Thanks for that as well. And this will be a fun ride.
Awesome.
So let's get into it. Obviously, a little background about me. You guys can see that. We also have our own podcast called No BS Wealth, where we bring out all the BS in the world when it comes to money. We have a plethora of experts that come on, and we go through everything that you need to know from a money perspective. But I don't like talking too much about myself just because that's who I am. However, I do want to speak to you. So not only from a flip perspective, but in real estate in general, the ones that do end up failing usually get wiped out by a couple things. One, just an overall market decides to do something that no one saw coming, right? Can't control that. And the other is usually the tax planning or the financial planning aspect of it. And so as we go through this, ask yourself, where am I? What can I attach or learn from? And then 3, ask the question so we can help you at the same time. So the first thing we always have any of our clients do is a self-assessment, whether it's on the real estate side, normal personal financial planning, business side, or hell, even your own personal budget. Is I always ask the first question is, what's your first money memory? And you'll be interested to think through that right now, everyone, right? What age were you in that memory? For me, I was 10. I had just gotten my own money. I don't know how the hell, I don't remember how I did it. But I did. Took my mom to McDonald's, went to buy her an ice cream cone, walked out. One of my friends scared me, and I crushed it and dropped it on the ground. Right? That is my first memory of money. Somewhat sad because I was trying to buy something for my mom. But I learned from that is I always want to be able to buy the thing again. Right? I always want to be able to get the second ice cream cone for my mom in case something happens. Now, a lot of you will say, well, didn't McDonald's just, you're 10, didn't they give you a new one? Yes, they did. And they were like 75 cents. Okay. So I get it. But that's who I am. That's where my money situation started, is when I was 10. And there's a lot of research behind it. Depending on where your money memory started, that's what age you are with your money. So for me, I was 10 years old for a long time until I got into this industry. So my question to you is, how old are you when it comes to money? So then we dive into the self-assessment test, and you can see the questions on here, which I'm sure you've looked through, and ask yourself these truly. What did it feel like when you're asking these, and do you have actual answers to them? If you do, fantastic. Then you can just go ahead, grab a beverage, and just listen along the rest of the day. If not, and you do have that feeling in your chest, then you're going to learn some things, and hopefully it's not going to spin you out of control, and it's going to let you get on a path of the right way. So we're going to go through tax planning today, some capital stuff, and just overall systems that we speak to our clients about, that we think that you should have as well. All right. We talked about taxes, but really a cash flow issue. So what happens? Um, we all love to roll our profit, right? Hey, I made money this one. Let's go do another deal. Let's move on. Let's keep flipping this thing over and over again. There's one key cog that we usually forget about, and that is our taxes. Not only reserving enough from our income because of, we'll say, capital gains, short-term capital gains, etc. We also don't think about how we can use that for our own personal financial planning, which will also reduce our tax, right? So it's something to always be thinking about. Whether that is, I have a rule that we use, and you'll see me on social media all the time. I hate rules. I hate like the golden rule of financial planning and tax planning. However, if you were to put a gun to my head, what should I reserve for taxes without doing planning? I would say 30%. Most business owners, which you are, I would put around 30%. Then do tax planning from there. But at least it has a generic number you can build into your plans. So what are some non-negotiables in terms of tax planning? One that's definitely not on here is that you need to do at least tax planning twice a year. So you need to meet with your accountant or whoever it is at least twice a year to get them up to speed of what you're doing, what's going on, and projected of where you're going to be at. And the reason for that is because there's a lot of strategies, which we will get to at the end of this or towards the end, that you might not be able to do. It's February right now. You might not be able to do now that it's past the year. You might only have until April to get it done, right? Or, hey, you are able to get it done before 12/31, but you wouldn't know those if you don't have that conversation throughout the year. Again, we talked about setting aside taxes every time. Pay your quarterlies if you need to, but the next important is making sure you're doing your books. Now, I get it. Not all of us are accountants. Not all of us like numbers, but having clean books really sets up the rest of your whole situation, your business, your tax planning, you name it. And no, you don't have to do the books yourself, right? There are bookkeepers out there from $150 a month to $650 a month. There's more, but just stay in that range. That I would say go higher, because this is something you don't want to spend doing every month, especially if you don't like it. Right, Ben, you can attest to this.
I was just about to say. No, you're right. I totally agree, and it's a fair point because often from the lending side you'll see investors redeploy. They wrap up a project and are on to the next. So it is super important to plan. And yeah, no, I totally agree, and you're right. On the accounting side, I can vouch for this.
Yeah, my first accounting course in college was Accounting 101, or I think it was 41. And like the first exam, I'll remember it vividly, was a blank piece of paper. And you had to create the balance sheet, income statement, all of those things from a blank piece of paper. Don't worry, folks, I got a 41%. Okay. So you could not like it and still be successful in life, I promise. All right. So a lot of us are going to have these questions around, what structure do I do? Right? Do I do LLCs? Do I do holding corporations? Do I do S corps? Do I do C corps? Do I not do LLCs at all? Your structure is going to be dependent on you specifically, but there's definitely two things I want to talk about. Your structure has two sides to it. It has the legal side and it has the tax side, and those are not the same thing. So I'll take example for an LLC for our example right now. Most of us have LLCs or thinking about getting LLCs. Those are designed specifically for legal protection, right? They are limited liability corporations. They are to help you from a legal side, not necessarily a tax side. Because if they're LLCs, you need to either figure out if you're a sole prop, if you're going to tax it as an S corp, what do you want to do? The tax has options. The LLC side is a legal protection. So make sure that you separate those ideas, and it will determine what you can do from a tax strategy perspective. A lot of the strategies we're going to talk about later are designed for those that are in the S corp-ish area. So just think through that. And again, if you have an LLC and you aren't taxed as an S corp right now, depending on your income, you can always file that and you can change that. It just get with your accountant on that. Again, I'm not a tax accountant. I'm not giving you legal advice, right? Disclosures. But make sure you're doing that. So the tax strategies that we're going to go through. These are the ones that not only my accountant and my team came up with, but these are the ones that we attack the most and we can see through. The Augusta rule, which is going to be a fun one. Board retreats, home office deductions, solo Ks, cost segs, all the way down. So we're going to take a little time on each one of these. But if you do have questions, do let us know. First one, Augusta rule. Yes, it came from Augusta. You know, the whole golf tournament thing. Down there, the ultra wealthy have homes that they rent out, right? Whether it's their home, their actual primary residence, or a rental, they actually will rent out their facilities for up to 14 days. Usually they do it the 7 days over the tournament. And they're able to, one, use it as a business deduction and not have to report that income or not report that income as income into their personal because of this rule. You can rent out your primary home up to full market rate. What do we mean by market rate or fair market rate? So what we do locally is we'll just say, hey, if I wanted to go to a hotel and rent out their banquet room for our company training or you name it, that is the market rate that you want to run with, right? So it's a fantastic strategy for those that, one, have a business, which, again, we all do, that we are able to then use our business to pay ourselves personally for renting out our home for certain purposes, right? Now, don't just rent it out for a Super Bowl party. Make sure that it is for business, whether it's team trainings, whether that's webinars, whether that's doing presentations on and offsite with clients, you name it, but you're able to do so as long as you stay under 15 days. We try to say do it around 10. It's the cleanest thing to do. So if that is something that you have or have thought about doing or have never heard of before, again, ask your accountant, but this is part of the tax planning thing that we can do. The next is board retreats. This one I love a lot. And I just did a video on my socials about this too. Because we all love to travel, right? Most of us love to travel somewhere, somehow. Thing is, for you in the real estate game, a lot of your traveling can be a business expense. And the reason for that is because you're going out to vet other properties, do business type activities. It's very easy to do for you in the real estate side. Even on the business side, if I was to, like my family and I like to do, go to Hawaii once a year, then we can have board meetings while we're there, which means we can deduct 3 days, both our flights to, flights there, our stays. Obviously, you can't do entertainment. Wish you could, but you can't. And we will have board meetings. We will sit down. We will go through our business. We'll do our annual planning, those types of things. And that is just like a normal board would do, something that you're able to write off. So if you're an LLC, S Corp, need a board, do a board retreat. It's very simple. Oh, I should side note. Make sure you take notes, people. Okay, take notes. Don't just willy-nilly do this thing. Keep your receipts, take notes. Be like you see on TV all the time with the board meetings and someone saying, hey, yes, yay, nay. Do all of those things as well. Home office deductions. Now, it is 2026. Most of us work from home, right? I do now too. I reduced my office expense from $5,500 a month in rent down to basically zero. Now, that being said, your home that you use and some of those expenses can be used as a home office deduction. Now, get with your accountant because they have this whole big old plethora equation that they use, but you can use a portion of each of your house to write off as an actual expense. You can do that with your utilities. You can do that with your phone bill. Obviously, you guys know the car stuff, which we'll get to later, but your actual square footage is something that you can write off as well. So if you're not doing that one's a very easy one and very easy to mark because guess what? You have a home office. There's a place in your home I am sure you're using for an office. Might as well jump on that. Solo K retirement. Now, this one hopefully doesn't hurt your brain too much. There's a difference between a 401k and a solo K. Solo Ks are designed for, I know, solopreneurs, right? It says it in the name, but also your spouse as well. And why are these so important? Because these can be used in a plethora of ways, okay? So I'm going to give you the generic side of what the solo K is, and then I can get into the side where actually you can use it for real estate if you wanted to. So What's great about solo case is not only do you get the deduction for putting in employee deferral, you can actually add up to $72,000 total in every year. So 24.5 from you as the employee, and the rest can come from a profit share, if you will, from your business, right? Huge write-offs right there. But also then you're real estate people. You love to have money. You love the flexibility to keep investing. What can I do with that? Solo case can be self-directed as well. And I'm not going to sell you on self-directed. I just want to give you the information about it. Self-directed 401ks or IRAs, you can actually use to either buy real estate or loan to real estate or anything in the real estate world. Also, you can do crypto, and there's some gold ones out there now too. But it allows you to use your money and invest in ways that you want to now, as opposed to the generic, just throw it in the stock market and see you when you're 67. So something to think about when you're looking at a tax strategy from a retirement perspective. Cost segregation studies. Now, as an accountant or a former one, Ben, when it comes to cost segregation studies, what have you seen be, I guess, not done or should have been done when it comes to this type of situation?
That's a good question. I mean, let's see.
And I don't mean to put you on the spot. I just
No.
I'm gonna hit upon the accountant a little bit just to see if any in the public side you saw that.
Absolutely. Yeah, just provide me a little more clarification on this.
Yeah. So cost segs, everyone should be doing these specifically for the rental properties, because when you have a rental property, you're going to have different types of depreciation buckets, right?
Yep.
You're going to have the building as itself. You're going to have equipment, you name it, right? They're all over the place. Doing a cost seg or having an accountant do a cost segregation for you will allow you to understand where all of those depreciation schedules lie and to come up with the better tool to attack those to get the most tax deduction wherever which way you want it.
Yep.
But also plan for the recapturing of all of that down the road too.
Absolutely. Yeah, no, I totally agree. And one thing I was going to say for all those that are listening, I think especially on all these tax strategies, these only really work when your books are clean and documentation is, I can't stress enough, documentation. I mean, that's your reference point. And any accountant, I mean, you got to take credit for documentation on these fronts. And yeah, I totally agree. Segregation of costs here, I mean, it's totally important, depending on separating the asset and specifically for taxes. Yeah, I agree.
Which goes into the play of, what's my return? What's my value in this property? Right now, I know a lot of what we just said is more focused on the rental side of things, but it's still in that same process when you do a flip. I need to know everything possible so I know exactly what my profit margin is going to be or what it's not going to be to see if I can vet or do the feasibility. When we vet out projects, we do all of this stuff because it matters, right? It might cost us a little more upfront to get these numbers, but I would rather go spend $1,000 to figure this out than to lose $20,000 in the back end, right? So then we get into the bigger deductions, the 179s, which the bonus depreciation is back. So thanks to the one big beautiful bill, it is now back at 100% until the foreseeable future on eligible property only acquired after January 19th of 2025. Good news is that was over a year ago. So if you have done that, then this is definitely something you want to attack and to achieve. But also, you got to realize it's not necessarily, when you're flipping, it's not about the property per se itself. We can use a lot of these 179s for the equipment and improvements that you're putting into it. So that's where most of your money is going anyway. Interior design work, exterior design work, maybe you have to do some engineering stuff. All of those are now at the 100% deduction. Now, again, not an accountant, not your CPA. Go figure it out. However, do not miss out on these because they are there. Okay. We do got a question. Woo!
Let's go.
As a buy and hold investor, what are some longer term tax mitigation strategies as depreciation from cost seg bonuses, depreciation diminishes over time? One, great question. When you start to phase those out, The problem is it's no longer in the property itself that you can do much. There really isn't once those run out. Now we're talking about you as a business and what are some other tax mitigation strategies, right? I sometimes call them tax avoidance, and my attorney said, don't use tax avoidance, bad idea. I said, fine, that's fair. But those come into play, Peter, like we talked about. How much more can we put into our solo case? Are we looking at doing 1031s? Like, are those in play for us? Outside of just the property itself, once you get through those, there's not much left on it, right? It's maxed out. Now it's using the income from those to do the planning. Again, solo case, hiring kids inside the business itself, potentially flipping that income to go to maybe you have a loss somewhere else, or hiring your staff. Those types of things outside of those depreciation times. So hopefully that answers your question. Vehicle depreciation. Again, this one's back. It has been expanded a little bit. But the key thing here is, I know we all have vehicles, but honestly, the weight matters. Okay. So the bigger your vehicle, the more you can capture. That's essentially how it works, right? There are caps, as we can see here at 32,000, but it depends on the size of your vehicle. I have a Silverado 1500, so all of mine is good to go. My wife has a Durango, so only half of hers was good to go, right? So you got to be able to piece that together within your tax planning. We won't hit too hard on the overall capital stacking, but we want everyone aware, and as Ben can attest to, there are a lot of different ways to get capital. Hard money, obviously we got some private money, some HELOCs, whether that's both a HELOC in your primary home, rental properties, lines of credit, refi exits, and other investors, etc. The key here for me, and I'll let Ben answer his thoughts on this, is
Sure.
having the flexibility
Yep.
and the ability to choose what is best for you in your situation, not because everyone else is doing it. And so I always attest, look at all your options, but also have lines of credit, whether it's your business or a HELOC, as kind of your savior, as your back end, while you're trying to get all these other potential different capitals stacked for you.
Right. Yeah, I totally agree. And that's why I think, hard money and these private money lenders have become much more popular over the last few years and have become so attractive, is exactly that, for flexibility. I mean, you go to a traditional bank, time is of the essence at times. If you're trying to close in a few weeks, a traditional bank might not be able to assist you with that. Whereas on our side at New Silver, speed is everything. And that's one of our strong suits. So yeah, it's, capital isn't always just about the rate. It is about flexibility, and you want your capital partner to be wanting to be your partner, right? Like, you want them to work with you, which, I've seen us, succeed on all fronts on that with our partners and our borrowers. It's just a personal aspect to your capital partner, right? So that's why I find, private money and hard money so attractive versus a traditional bank. Like I said, the borrowers we are borrower facing, right? We're always going to be trying to work with you from the very beginning to closing, all the way right out to the end, to where, you complete and hopefully move on to a next deal.
And let's be real, the ultra wealthy do this. Now, it might not be through New
Yep.
Silver per se, right? But they're doing it through themselves. They're figuring these things out because they don't want to go the traditional route for a plethora of reasons.
Yep.
But usually it's speed and flexibility. Everyone gets caught up on interest all the time and the cost of what this is going to be interest-wise. You build that into every project, right? Like, that is built into what you are wanting to do. The problem is you're wanting to do this and you need to do it in the next 30 days. Your flexibility matters more than the interest rate. Okay. So don't get caught up on interest rate all the time. Don't get caught up on those terms per se. Is it fitting the plan in place that you have put for this project, maybe for the next project, or just the overall flexibility of being able to say, hey, Ben, I've got this deal and I need to turn in 10 days.
Yep.
And if you've been working with them, cool, they can get it done. Boom, we're off and running. Even if it is 10, 12, 13, 14%, which I don't know the rates. I don't know all of those. But even if it is.
But no, yeah, I totally agree.
Even at those rates, things can happen. It just matters of your
Right.
time. So don't lose it all because of interest.
Absolutely. Absolutely.
And I know I want to attest to this now. I know all of us are in the real estate game, so we understand leverage. However, on your personal side, right, I always challenge everyone to this is obviously debt is not evil, but debt equals leverage. Leveraging others' money, right, like a lender's money, or leveraging humans, people who work for you, is the ultimate tool to achieving whatever goals you have from a monetary perspective. Okay. If you want to be rich and do all those things, you have to use leverage. You have to leverage humans and you have to leverage other people's money, typically lenders, right? Now, when I say leveraging humans is you need a team. There's not one ultra wealthy person or successful person on this planet that has done this 100% by themselves. So you need a team, whether that's a lending team, whether that's a planning team like us, your accountants. Obviously, attorneys are nice to a degree, although they charge too much, in my opinion, sometimes. You need a team around you to get things done. So don't always think that you're in it by yourself, because there's a lot of people here for you in general. So again, stress test yourself on every deal. I know we threw a lot at you from that perspective, but also just run through everything, make sure your numbers foot out, and put all of your contingencies that you've seen in there as well. Okay. I appreciate people who love getting in their financials all the time. When you are dealing with real estate, I think you need to be in there weekly, specifically. On the flip side, you need to be able to understand and project a lot more. I see people fail the most when they don't project forward and they just do it for, let's say, hey, it's going to sell in 60 days. And now we're stuck at 90, 120, 180. Peter got another question. Do you recommend using refinancing to reduce taxable income and growth wealth? Example, would you be refinancing into a higher interest rate, higher balance to reduce annual taxable income on your rental property? Ooh, that's a good question. Again, I'm in my industry, so my answer is always it depends. And it does. There's some variables there, right? What is your overall tax rate? Where all is your income coming from? Two, when we're refinancing into a higher interest rate, like how much higher are we talking about, right? Right now, I'm in our home where I like a 3.25% interest rate. That's really low compared to if I was going to go get one for 7, 8, 9 now, right? That doubles it. So it depends on that situation. It then also depends on if you're going to do a cash out refi and what you're going to use that cash for. Are you going to reinvest it into something else? And maybe you reinvest it into another property that helps you more with the depreciation in your taxable income. Are you going to invest it something else, maybe in retirement, etc., that also will retain that? So the answer is it depends, but yeah, definitely is an option as long as the numbers work out for you. As you set up your business, you should always have different buckets that you're thinking about. You should have your tax reserve. You should have your a bucket or an account for your project contingencies. We usually say about 20%. And then you need to have a business runway. Now, all of these numbers are different for you than they are for me. However, we try to make sure that your business can operate when you're first starting for at least 60 days. When you're a few years in, now we're talking about operating a full year on its own reserves. That way, anything happens, you can be okay. From a project contingency, the same thing. We all know things go over budget almost all the damn time. Like some things are in our control, some things aren't. I got an interior design client of mine, and she usually makes sure that everyone pushes their budget. Trust me, because she redid our house too. But those are things that you need to keep in line as all the time. Again, back to the structure and protection. I don't need to hit a dead horse on that at all, but I want to get us time for more Q&A, if you will, at the end of this. So go ahead and think everything we took from this. If you guys do have questions, whether it's now, go ahead and ask them. Or if you need to reach out to Ben and I later, please do. We're here. I love talking, and I don't mean on my high horse. I mean answering questions. I think the transparency and being able to answer the questions that you have is vitally important for not only your success, but if you're successful, then the rest of us are successful. And the more we can help each other grow, the better we are as a society. So I appreciate everyone's time. And if you have questions, go ahead and ask them. Ben, I spoke a lot. So if you have any
No, I couldn't agree more, man. And thank you so much. I thought you did an awesome job. And Had a lot of great talking points. Yeah, I want to thank you, Stoy, personally. Thanks for joining us here today and providing us with an awesome presentation. And thank you all for joining, all those that are listening. Pleasure to have you on here, and we wish you all continued success. We will now open the floor for the Q&A. And yeah, like Stoy said, if you have any questions following this, feel free to reach out to me directly at ben@newsilver.com, or you can reach out to sales@newsilver.com. And if you're a real estate investor looking for a loan, come to New Silver. We're happy to be your partner from the beginning to end.
Questions? Don't be shy. Peter's been the only one to ask.
I know, Peter. Thank you for the questions.
Yeah, appreciate it. No, he's not a paid actor, everybody. What are some questions that maybe, Ben, that you've ran across in your time in the lending side that maybe usually gets asked, but people forget to ask?
That's a good question. I'm trying to think. I mean, I got to give us credit because I really haven't seen, from our perspective, we're really lucky. We have a lot of great borrowers and haven't seen any real issues on the tax side in this regard, which we owe, credit to some strong underwriting guidelines. But no, I think just overall, like to your point, planning, exactly that. Like if you're coming for, financing, it is important to be prepared for these unsung costs that you might not know are like they're not going to be in your budget, right? So we do always prepare a contingency for that exact reason, just because we understand that as you go through a project, you might budget for architectural fees for 20 grand and then they come out at 25. So we totally understand, and again, we work with our borrowers through and through on that exact reason. So to your point, I think it's just important to, like you said, leverage. It's very important to be, this is a well thought out plan, and, plan your work and work your plan.
For sure. Brendan has a question. So I'm on a rent to own platform. Should I be maximizing my HELOCs in order to have additional funds? And what's the tax ramifications on that? You absolutely should. In my opinion, I think everyone should have a HELOC out. Now, it doesn't mean you have to utilize it, right? So for example, you get a HELOC out, say it's $100,000, and you don't need to use it. There is no tax ramifications. You're not using the money. You don't have to worry about it. Now, if you do go to use it, a lot of platforms for the first couple of years, you only pay 1% of the whatever you have outstanding for that length of that term. And so one, it helps you with cash flow specifically for flexibility purposes. And or if you need to use that for an investment, you now can tie that into that investment. Then the tax ramifications would be, hey, you can have interest deduction because you're paying interest on said loan. Depending on what you use the funds for, it might qualify for some of those depreciation things that we had talked about. And then if you're using it for an investment, then you obviously could potentially have the depreciation plus the interest on that as well. These are land contracts with my renters in the home on every property. Then yeah, fantastic. Go figure out where you can get that HELOC. I'm not specifically know where you're at, but there are places out there to get that, and then you'll have that capital available. Just make sure that you don't run it up like a cheap credit card, and have a plan for it, right? Ben, do you guys do HELOCs on land and stuff?
No, I'm not. I don't believe we do. What is a healthy runway? Okay. And I got one more question here, and then we should wrap up.
What does a healthy runway look like for someone running 2 to 3 flips at once? Again, it depends. But I would say, depending on the variability of what your plan is for those flips, I would always have, from a flip perspective, at least another 3 months built-in runway per flip, right? And the reason for that is it allows you that flexibility. Now, granted, yes, you might nail it and it might be sold immediately, but you just never know. And if you build it in that way ahead of time, then you don't have to feel the pressure of taking a deal when you don't want to. And in my opinion, that is one of the most important things when it comes to real estate, is being able to either purchase when you want to or sell when you want to, and not what is dictated to you because of unknown variables in your path. Owner finance property at first lien. Got it. Yeah, there's borrows out there, or lenders out there for you, Brendan, for sure. All right, so we got to wrap up.
Sounds good. Stoy, thank you again, man. This was excellent. And, I'll definitely shoot you a note after this and keep picking your brain. But yeah, we appreciate having you on and appreciate all those who joined us today.
Yeah, I appreciate everyone. Again, you can find me at blackmammoth.com. You can just Google Stoy Hall. I have too many socials out there. If you do have questions, just reach out and ask. Honestly, we're here to answer you. If it gets too detailed, then obviously we're going to say, hey, obviously you need to book us because we need to go deeper. But please do ask, whether it's now or 6 months from now. We're here for you.
Awesome. All right, guys. Well, thank you very much. Stoy, enjoy the rest of your day. And thank you again.
You too.
All right, guys.